Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is covered calls and short puts. And sometimes in an investor or trader's career, they have to make some tough decisions. And one of those is knowing when to pull the plug on a stock investment while we're selling covered calls. Do we keep selling covered calls, or is it time to just sell the stock itself? That's what we're going to be talking about today. We have three examples in our paperMoney portfolio that can help us talk through the pros and the cons involved in that decision, so it should be a great discussion. Before we get to that, though, let me first of all say hello to everybody who's already chatting in. Great to see all the familiar names out there in YouTube. Hello to those who are new as well, but hello there, Scott, Hamlet, John, Tony, Josh, Lawrence, JRTR, JDLMI, Eva, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you happen to be among those that are here for the first time, welcome. Great to have you on board. And if you're watching on the YouTube archive after the live stream is concluded, well, enjoy those recordings. That's a great way to watch these webcasts. But if you'd like to be here in the live stream, this is a Monday webcast series. We kick things off promptly at 2 Eastern time. We'd love to have you here in our audience. Now, as a special treat for my live stream audience members, my very good friend Barb Armstrong is hanging out in the chats with us today. Barb's going to be keeping an eye on those chats and any questions that she spots that I can't get to. She's going to help me pick up the slack with those. Thanks for having my back there, Barb. Barb and I have been working together for years and years and years, so she brings a ton of experience to this. Thanks for being there, Barb. And Barb and I would also like to issue an invitation to everybody listening to follow your favorite Schwab presenters on social media. Now, you can follow Barb and me on X. You can find Barb on X at Barb Armstrong CS. You can find and follow me on X at Cameron May CS. You can also follow us on LinkedIn. So track us down there as well. But if you follow us, and if you reply to one of my posts on either one, X or on LinkedIn, I just try to reply right back to you. It allows for interaction when the cameras aren't on. But let's get into this discussion. And of course, as we do, there are risks associated with trading and investing, certainly risks associated with covered calls and short put selling. So bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Investing involves risks, including loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set the agenda for today's discussion. And today, I really want to focus on that difficult decision that a stock owner sometimes is confronted with when they're pursuing income, but their stock is struggling. Some might be going sideways for an extended period of time, just not being productive. At other times, the stock might be going down. When does the investor or the trader decide to just pull the plug on the stock? Or is it maybe a better idea to just keep selling covered calls for income and hoping that makes up the gap? Well, we're going to be looking at some examples of just those scenarios today. We have 3 stocks in our paperMoney portfolio that have either just kind of not done much, or they've even started going down. So we're going to talk through the pros and the cons, the sorts of considerations that an income-oriented trader might keep in mind as they're trying to decide, do I keep selling covered calls, or do I just sell the stock and be done with it and move on to something else? So let's get right into that. All right, so let's go right here. We actually have a good number of positions as we go to our paperMoney portfolio. We have 5 active positions. We have a few that, time permitting, we'll also review some that have wrapped up recently. But the 3 that I wanted to focus on, just right straight out of the gates, are Apple, Amazon, and Nvidia. You'll notice with each of these, the quantity just says plus 100 or plus 200. So that indicates that those are just stock positions, but these have been covered call positions in the past. We've just seen these contracts expire. So let's look at Apple and let's make some decisions. Let's weigh the pros and the cons about whether should we just keep the ownership of the 100 shares of Apple, continue to sell covered calls, or should we wrap it up, move this, maybe move these funds on to something else? So Alex says, sorry, slightly off topic. When is the getting started with options less than 2 of 10? I think so, Alex, you're talking about maybe, well, you can check the archives for that. by the way. I don't mind this actually. Let's hit the pause button on Apple for just a second, because it's important for everybody watching to know that we have a deep library of previously delivered webcasts, including lesson 2 of 10 for getting started with options. Let me show you that. So if we go to our thinkorswim, our Trader Talks channel on YouTube. So first of all, do yourself a favor. If you haven't subscribed to our Trader Talks channel on YouTube yet, do that now. Just go down below the video, click on subscribe. It only takes a second, doesn't cost anything to do that. But this is where you can join our live streams, but you can also find the playlist for previous webcasts. So for example, if I were to go to playlists here and scroll down a bit, let's go, I'm actually, in this case, going to need to go all the way down. But if I go down toward the bottom, we'll see getting started with options. And if I click on view full playlist, I actually do have a series of lessons for those that are brand new to options. I go from lesson 1 to lesson 10, and those are all archived already. So you don't have to wait for lesson 2 to come out. They're already all there. What you'll do is just scroll down until you start to see the word lesson pop off your screen. So there it is. See that? It took me about 3 seconds of scrolling. There's lesson 1, there's lesson 2, there's lesson 3, and we can just watch those in rapid sequence if we like. All right, so thanks for the question, but back to our portfolio. Let's see what's going on with our Apple. Right now, it shows that we're up a bit on those shares. On 100 shares to be up $288, that means we're only up about $2.88 per share. It's not a lot of movement. Here's what's actually happened with Apple. Here's the history. Let's bring up Apple. So this all started with selling puts. We originally sold 2 December 19th 265 puts. Those actually just expired. They were not assigned. And we kept that 277 premium. That just became a realized gain in our paperMoney portfolio. Then we sold one more 16th of January 265 put for $2.70. It's a little bit obscured, but that's what we did. That one was assigned. So what wound up happening there is we kept the 270, but we also were required to buy the shares for $265 per share. Now, as shareholders then, we made a decision to sell calls. So we sold 20th of February 275 call right here. That's what this pink line here represents. Pink just indicates that we had an option there and it's expired. I just draw these on here just to show you what's happened. So that one just expired. So we find ourselves now with some realized gains on some contracts that we've previously sold, but now we just own shares of stock. Bought the shares for $265 according to the put contract that was assigned. But those premiums have actually lowered our break-even point on this trade overall down to $254.33 if we also include this little dividend that was paid, 26 cents. So there's our break-even. We paid $265 for the shares, but that income has really helped to lower the break-even point. So Chuck says, what days were the trades? So Chuck, when you see a line on my chart, I start that on the day that the trade was initiated, and then I'll end it on the day that the trade concluded. Now, sometimes there'll be some overlap, like this 265 put for the 2nd of December is at the same level as the 16th of January, so they sort of run together right there. But we basically were in puts for that entire stretch. All right, so hopefully that's helpful for you. But there's our break even. But let's put ourselves in the shoes of this hypothetical shareholder. They own 100 shares of Apple. They don't have any sort of contractual obligation. That has run out already. So now they're just trying to decide, maybe as they're looking out over the horizon, whether they should retain ownership of those shares. We could sell the shares right now, probably take a profit on the purchase of the shares, bought the shares for $265, we're up a couple of bucks. So we could probably realize a gain on those shares to go along with all the premiums that we've collected and the little dividend that we collected and just call it good. That's a possibility. Or if we're still income oriented, and if the investor or the trader here still thinks their stock is bullish, that's an important decision there. If we really think the stock is going to collapse from here, that could just really cut into the overall profitability of this trade. But we might decide to just close it out. So what do we think? What are some considerations? Well, one thing that an investor might look for is what's happening on the chart. And what I note here with our chart is the stock has really been having a nice run since April. And it looks like, and by the way, do me this favor, if you would, if you're watching in the live audience right now, give me a quick chat. I just want to do a quick audio video check to make sure that everything is still functioning. Things have gone a little bit quiet for just a couple of minutes, and I'm just being overly cautious. But in any case, what a technically oriented income investor might do is look to see if they still are bullish from a technical perspective. And so here's one look that our hypothetical investor or trader might take. Going back to these April lows, if we draw a line connecting those to the lows that we hit there in August, hey, thank you, Barbara. That's all I needed to see. Barbara says, okay, I'll take her word for it. Jerry, thank you. Scott, excellent. All right. But let's pull our line up here to the present day. And what we might note is that it seems like the stock on its way higher, it'll make typical stair-stepping patterns on its way. But it seems to be that each time it pulls down in the neighborhood of this sort of rising floor, that's been acting as a pretty good support. And very recently, just over the last week or so, we've pulled down to that support level again. In this case, it happened to coincide right about with the break-even position of this trade since we started, and we're starting to rise again. So a technically oriented investor might say, hey, it looks good. As long as their outlook is that price is likely to continue to climb, maybe they'll retain those shares, feeling pretty good about those, and sell a covered call. So I'm going to be doing that. All right, for this one, that's what we're going to be doing. Which covered call? Well, I wonder, it looks like a recent resistance or price ceiling might be up here around 280. I haven't looked yet, but I wonder how much we might be able to get for, let's say, a 280 call going out there to the March expiration. User, thank you. Appreciate it. Let's go have a look at our option chain. Go to the trade tab. Let's go to the 20th of March. Those are those monthly expirations. You'll see me demonstrate those quite frequently, even though we have other choices. Apple is among the only 9 securities that now offer these Monday and Wednesday expirations for the weekly contracts, but the greatest liquidity still tends to be on the monthly contracts, those third Friday expirations. So those tend to have the narrowest spreads, maybe at least theoretically easiest to get into and out of because of that enhanced liquidity. But let's look at that 280 strike, and it looks like that's trading between 252 and 256. That's about 1%, not quite 1%, for about a 25-day position. I think that's the one that we're going to do today. Now, in this case, we just have 100 shares, so let's sell one contract. Let's click on the bid price. Let's create a sell order for the one contract. So here we're obligating ourselves. We're getting into a contract where we have the obligation through the 20th of March. Someone else can buy our shares for 280 bucks at any time. They can do it now. They can do it at expiration. It's more likely the closer we get to expiration or at expiration, especially if the stock is above 280. But even an out of the money contract can be assigned. We just need to be aware of that. So yeah, Mark says you're fascinated. These Monday and Wednesday options expirations are possible now. You're going to stick with the monthlies for now. I think that there are plenty that might come to the same conclusion, but there are also others that might be early adopters. Just be aware with those new options. What happens with new options is they haven't had much time to attract much of an audience yet, and they can tend to be a little bit less liquid. However, on stocks like those that are now trading the Mondays and Wednesdays, they tend to be highly liquid stocks. Their options tend to not suffer quite as much from the lack of liquidity. Anyway, but let's see if we can get, looks like our natural's at 249. Should we try to get 250? I think I'm going to leave that at 249 for our limit. Let's lock that in, and let's click confirm and send. So we're attempting to sell one Apple 20th of March 280 call, try to get $2.49 for that. subtract the commission from that to give us, that would give us a minimum acceptable credit of 248.35. Let's send that off and see if we can quickly get that filled. And it looks like, yep, we did. Sold that for 252. Okay. So there's one example of maybe an income investor who's still bullish on their stock, despite really, since we were assigned these shares, bought them for 265, they're hardly productive, but it's actually been adding the premiums and even adding a little bit of little additional spice from the dividend that's helping to boost the overall performance. Let's see, High Spirits says, if you're happy with selling the shares at 280, why don't you sell longer days till expiration than 25 days to collect a higher premium? That's a good question. Yep. Could we have gone out further? Even if we're sticking with the monthlies, instead of going March, maybe go out to April. There, we're getting a higher premium, but we're also in the obligation of the contract for longer. And here's one thing I would say, is that on a day-to-day basis, even though that premium, the net premium is higher, the day-to-day premium is actually lower for those longer dated options. So for some traders, their preference might be to sell somewhat shorter term. And instead of over the course of, let's say we have 2 months, instead of saying a 2-month contract, they sell 2 1-month contracts. And the combination of premiums between those two are probably going to exceed just the one single contract. Does that help? Is that helpful? Anyway, there are pros and cons always in these decisions, but thanks for the question. Let's move on to our next trade, though. We have Amazon shares. And we actually have 200 shares of Amazon. So let's see what the history is there. Yeah, Mary Burns says the theta premium, that time decay element, the day-to-day potential for income, is actually lower for those longer term options. Now, that's not to say there's something inherently less valuable about those options, because in the case of a really strong, let's say, single or 2 or 3 day counter move, there may be more protection offered by that longer term, larger premium option than by a shorter term, smaller premium option. So there are pros and cons. Let's go to the Amazon position. Here's what's happened to us here. Possibly quite a different technical scenario, right? With Amazon, here's the history. Sold some puts back here. So if we want those started right here on December 8th. Sold 2 January 16, 215 puts for $3.70 per contract. We closed one of those for a 303 profit, so we paid 67 cents to exit that one. We closed the second one right here for a 365 profit, paid 5 cents to get out of that one. And then we sold some more puts. We sold 2 February 20th, 235 puts. Those just expired. And the stock was solidly below 235 at that time. So we got assigned shares. We had to buy those shares for 235 at a moment when right now they're only worth 204. Can I round that to 205 for some easy math and say we are underwater to the tune of about 30 bucks. Even taking the whole history of these premiums into consideration, our break even is way up here at 226.06, and we're trading way down here at 204. Now we own the shares. What do we do with them? Let's look at this again through the lens of a technical investor, a technical trader. Income may be their primary motivation, but if they're getting little bits of income and at the same time the stock is just falling through the floor, the capital depreciation of the shares can certainly overwhelm any income benefit being collected from the premiums. And that's really what this one is confronted with. Now, here's a question I have for you, though. Let's have a look at, do we sell the shares right now? Do we hold on for a little bit longer and see what happens? So one technician might make this argument. Well, Cameron, it seems to me we're sitting right above a previous resistance that has been acting as a new floor for about 8 or 9 months. So if we sell right now, if that floor holds, maybe this is the start of something new and we're just about to go up. And so selling right now might be just the worst time. Yeah, Chuck says this went over earnings. That's right. So Chuck, here's the recent history in this webcast series. So if we roll the clock back 3 weeks ago to right before that earnings announcement, we met to discuss what to do with this. We decided to hold on through the earnings. Now, after that, we had 2 weeks. The first week, I had a whole bunch of new people come to my webcast. So I decided we weren't going to do any management of trades they weren't aware of. Instead, we were just going to focus on learning a concept. So we didn't do any trade management 2 weeks ago. Last week was a holiday, so we didn't do any trade management there either. So here's where we find ourselves. We're now 3 weeks down the road having to confront kind of reality with a trader who doesn't pay attention to their portfolio for a few weeks. Here's what's happened. What do I do now? Yeah, Mark says it's an uncomfortable feeling owning a covered call and watching the stock fall. It's tempting to just keep selling calls to make up for the loss. There's the point there. Yeah. How good of a job is selling calls and even selling the original puts? How good of a job is that doing in keeping up with the losses that we've taken? Not very good. We're still 30 bucks underwater. Not 30 bucks. We're about $22. We would be, it's not, let's give some proper context here. We did have to buy the shares at 235, and had we not done the covered call here, now that's $3.65 that's helped, but it didn't erase all the pain. It just put a little Band-Aid on things. All right, but let's decide. What should we do from here? There's that one technical perspective. It seems like we might be just above a price floor. I think that someone else might come in and say this. Yeah, you're making excuses, Cameron, because more recently, we've fallen below a price ceiling. Look at this. Several touch points, but stretching back over now about 7 months, there was a support around 210 or 211, and we've fallen below that. So it might be a little bit of a tug of war. One technician might think price is supposed to go up from this floor. Another one might make the argument price is more likely to head down from this ceiling. What do you think? Chuck's saying you have the gap. Yep. Chuck's taking a look at this right here. A common assumption among technical traders is when there's a strong gap in one direction or the other, that gap might act as support or resistance. So here we had a strong gap down, and the bottom side of that gap might act as a new area of resistance, a price ceiling, and it seems like it is. Well, let's say, in this case, what should we do? Well, maybe we're not entirely sure whether this is going to go one way or the other. If we own 200 shares, maybe this trader might decide, how about we pare back on our exposure to the stock? Let's cut that down, but we'll retain some ownership to provide some possibility for recovery. Maybe this thing can get back on its feet, but let's just make a plan. Let's do this. We're going to keep some shares, and I'm going to make a note right down here. Sell remaining shares if support breaks. Okay, that'll be our plan. Let's make that one blue. It's my preferred color for those sorts of notes. Eva says we're going to split the thingy. Yep, that's what we're going to do. So let's do this first. Let's right-click on Amazon, and we're just going to take some of our lumps. Let's sell not 200 shares. Let's do 100 shares. And I'm just going to put this in a market order. Some people prefer a limit order to try to control that exit. When I'm doing a webcast, I want to get this filled as quickly as possible. Market order tends to do a better job of that. But obviously with a market order, we might not be thrilled with the price that we receive. Right now we're trading at 204.38, but that's certainly not guaranteed. Let's click confirm and send. We're going to sell 100 shares of Amazon, closing those out, stemming the bleeding on those. No commission on this trade, but there can be on some types of trades. But we're going to retain the ownership of the, looks like we sold at 204.40. Okay. So that's a realized loss on those shares of $10.60. $10? No, it's more, on the shares. We got it at 235, right? $30. Okay. Anyway, but on the remaining shares, let's go ahead and sell a contract. Which one? Well, if we think this might be resistance, how about we look to sell up above that? Now, as we do that, we need to be very aware of this. So let's say we think there's a resistance at 210, so maybe we sell the 215. I wonder if we can get anything for a 220 call. I don't know. Let's go have a look. Look at the 20th of March again. Okay, the 220 calls are selling for about 205, 208. That's right. Boy, that's right smack dab on 1% for those that have that sort of a rule for their trading. But let's click on that and let's sell that one call. But I do want to talk about the realities of what this trader is getting themselves into. This is a big deal. All right, but if we sell that call, let's do it, and then I want to talk about the reality of what we've just done to ourselves. All right, natural's around 206, mid's around 208. Let's just say we're willing to settle for the natural. Let's put that as our limit. See if we can get 207 out of this deal. Let's click confirm and send. So we're selling the one Amazon 20th of March, 220 call, trying to get 207. There is a commission to be paid, so that reduces our credit if it fills by 65 cents. Well, let's send this off. We sold that okay for 209. Here's the deal though. I said something important that we need to discuss is happening. Let's draw in a line there representing that 220 call that we just sold. That's going to be right about here, close enough. Carry that out to March. We now have an obligation to sell our shares for 220. Someone can buy it at any time for 220. How much did we pay for the shares? 235. We've just now agreed that we will sell the shares to somebody else for less than we paid for them. That sounds terrible, but it is also at the same time agreeing to sell the shares for more than they're currently worth. So pros and cons. Eva says we go further out in time, maybe get a bigger premium, right again even, maybe lower that break-even point a little bit further. Where would our break-even point be having collected 209? That would bring that down to about 220, pretty close to 224. I'll update all these numbers and these graphics after the webcast is over. So that's another way that a trader might decide to manage a position. Now this next one I think is going to be kind of controversial. Let's go look at our third position, our Nvidia shares. There we go. So here's our Nvidia history. We bought 100 shares at $183.71. We sold a call, closed that for a $343 profit. We sold another call, that expired for a $340 profit. Sold another call, that expired for a $1.93 profit. Sold a fourth call, that expired for a $375 profit. So our break even is all the way down here at $171.19, including this little 1-cent dividend that was collected. So here's a stock that really, the stock itself hasn't done much. Bought it for a 184. It's at 191. It's okay for someone looking for like massive appreciation. They're not getting that, but it's not bad. But overall, the stock has been up and it's been down, and it's largely been the premiums that we've been collecting along the way that have been adding to the performance of this trade overall. So here's where we find ourselves right now. We still own 100 shares. None of these calls were assigned, so we still own 100 shares. This contract just expired Friday. Today's Monday. That contract expired Friday. So we're under no contractual obligation. So what might, let's say, our technically oriented income investor do here? Well, the stock seems to be doing okay. One thing is it does seem to be up here against a resistance that's held for a while. And they might see this as this is about the best exit I've been able to get for the last several months. Maybe they just pull the plug. Somebody just asked a question, wouldn't that trigger a loss that it's not deductible? It's a good question. We do not discuss tax implications of trading. You might think, Cameron, why don't you do that? It's not within my role. It's not within my licensing, so it's just outside my role as an educator. As always, we suggest if you have tax questions, definitely consult with your licensed tax professional. All right, yep, exactly right, Eva, thank you. Anyway, so one consideration here might be we're right up against the price ceiling. And if we think that price ceiling is going to continue, maybe our investor just says, done. But it's also possible they might say, yeah, but so far so good. What if I just keep doing what I've been doing? And as we rise to this ceiling, I sell a call. Rise to the ceiling, I sell a call. Historically, we sold right here, we sold right here, we've sold right here, and one we squeezed in here, right about there. Anyway, what's another consideration? High Spirit says, should the earnings report in the next day or so be considered? That is definitely something that I wanted to talk about. Yep, because in this webcast series, we have typically not sold covered calls over earnings announcements. And when I do something a number of times, especially if I do it sequentially, like choosing not to sell a covered call over an earnings announcement, it starts to sound like, oh, that's just the way it should be done. I don't want anybody to get that impression. There can be pros and cons to these sorts of decisions. So today, we are going to sell a covered call. We're going to keep the shares here, not going to sell them. We don't have the option to reduce them. Then we wouldn't have enough shares to sell a covered call, even if we wanted to. But this time, I want to put myself in the shoes of the income investor who decides to go ahead and sell a covered call right before an earnings announcement. Jerry says, wait for the earnings report. It could blast off and then sell a call when it slows down. That could happen, Jerry. What else could happen? It could collapse, in which case the call could help take some of the sting out of that drop in shares. So as always, there are pros and cons to each decision that we're making. Let's look at this. So here we are. We're right up against the price ceiling. Maybe this earnings announcement blasts us through that, or maybe the stock just peels back. I wonder, let's see, our resistance is there at 195. Let's go have a look to see what maybe we could get for a 195 call. That's what we've been selling along the way, or maybe even a 200. Let's go to the trade tab. Let's look at the 20th of March. And one thing that we should be aware of, so let's look at 195. Why not? That's where our price ceiling is. That's where we've sold premiums in the past. But if you look at past premiums, we got $3, we got $3, we got $2, we got almost $4. What might that trader get right now? Same strike price. We're pretty close. That's one consideration. But also, with an earnings announcement right around the corner, what typically happens is premiums go up in anticipation of the volatility associated with that earnings announcement. And so now instead of $2 or $3 or $4, the trader might get $8.50. What can that do if the stock goes down? Well, now we got $8.50 of income that can help take some of the pain out of watching our share price fall. But at the same time, if the stock goes up, yes, we still have the obligation to maybe have to sell our shares for 195 bucks. There are pros and cons to this decision as well. But here's what we're going to do for today. We're going to go ahead and sell another 195 call right there. We'll go above today. We'll carry that out through that March expiration. So I like to draw that in to visualize where our ceiling is. You can see how close that ceiling is. If the stock goes above that, we don't get to participate in any further appreciation in the stock price. But in exchange, we might get $8.30, $8.40, $8.50 per share on the premium. Let's go see how much we can get. Let's go to the 195. I'm going to click on that bid price. Let's sell just one contract for our 100 shares. And how about we see if we can get $8.40. Let's lock that as our limit. Click confirm and send. And we're going to sell 20th of March, 195 call for $8.40. That brings in $840 potentially in income that can help us if the stock falls. It's not, some people say it's insurance. No, it's not insurance. Nope. That's like having an insurance policy on your house that replaces the roof if the house burns down. It makes you feel a little bit better, but nope. If this stock collapses, $8.40 per share is the maximum pain that this contract could remove from that. All right. Anyway, so we have a 65-cent commission to be paid. Let's send this order off and see if we can get it filled. Let's go to our working orders. All right, we're asking 840. Yep, I was going to say it's trading at 852, so I liked our odds. Okay, we sold that for 850. Let's talk through now what we've done to this trade. I've sort of spoken generally about it, but now we have specifics that we can use. If the stock goes up above 195, well, even if it's below 195, the other party in this contract can choose to buy our shares for 195. All right, well, we bought the shares for 183.71. If we sell them at 195, that's about an $11 and change profit. But we now also get to add to our pile another $8.50. So that's if the stock goes up. If the stock goes down, well, we're the shareholders. We're the ones that are losing the value in those shares, but at least we have $8.50 in the account to help compensate for a drop in the share value. Okay. Yeah, JRTR says you usually get higher premiums over earnings. That's right. Not every time. If shareholders aren't really expecting much reaction from an earnings announcement, the premiums might not go up very much. They may not go up at all. In this case, it certainly seems that we're getting a larger premium than we've seen historically. That's more typical. All right, so that's going to be it for that discussion of, when might a trader decide to continue selling calls? When might they decide to exit or to partially exit a position? But really the bottom line is the income, while nice, if we're able to achieve it, is not really the driver of the bus here. It's really the stock ownership that provides the most upside potential and the most downside risk. So if we get to a point where the trader or the investor thinks the stock is really going to start to collapse, maybe they choose to just exit it then, because the income is unlikely to make up for big losses on the stock. All right. So we have a little bit of time. Maybe we'll do a quick glance at, we have a couple of remaining positions. I will say that we had 3 positions. We'll quickly touch on those that closed out. But AbbVie, we own 200 shares. We've sold 2 calls on this. It's kind of at a break-even point right now on the current construction of the trade. Bought 200 shares at 227.18. We've sold some calls right here. This is our current call position. Sold 2 March 20 calls for $1.65 up here as those strikes. But we've already realized gains, $1.93 and $1.83 on previous contracts. So that's not included in the 44 bucks or whatever our current covered call is making. Our break even's actually down here at 220.04, and that seems like it's doing okay. So we'll leave that one alone. Not going to be making any changes to these other 2 positions. With our Microsoft position, actually, I was actually thinking about closing out this Microsoft. This thing is refusing to cooperate. Here's our worst current position. Microsoft, we've sold a put. It's a bullish position, hoping to get some sort of just a rally over the course of the next couple of years. This is a 21st of January 2028 contract. Doesn't expire for a couple of years, but almost from day one, this thing has just been misbehaving. This has been, just working its way down and down and down. We had a note here to close if support breaks, but we haven't had a discussion since then. Support is broken. I'm closing this one up. Ripping the Band-Aid off. Let's create a closing order to buy that put back. We sold it, I think, for 34 or 35 bucks. We're going to have to pay about $55 to exit this. The 380 put, this one, let's see, that's only about a 35-cent spread. Let's let's see if we can maybe get out for a little bit less. I'm gonna leave that pretty close to the natural just to see if we can give it a good likelihood of getting filled. Let's buy that Microsoft put back. Try to buy it for $54.90. There we need to add in the commission, so bringing the total cost of exit to $54.90.65. Let's send that order off. That would be, yep. So we just realized the loss on that one. That's the way it goes. Sometimes the trades don't work. So Microsoft is off the table now, leaving us with 4 example positions. We'll follow up on the other 3 next week. But basically, we had a PG short put that just expired. Actually, I can knock these out quickly. So PG, our short put expired for a profit. We can get those on camera. Google or Alphabet, we were assigned for a profit right here. Bought some shares, sold a short-term call. That call was assigned for a profit of $613 or $6.13 on the stock, plus 305 for the call that we sold. Visa didn't do well. There we go. Visa, we were stopped out. That's it. Barbara says, explain why you chose the natural price to sell. Barbara, that just basically means I was going close to the market price because the camera's on, the clock is ticking. I only have a few minutes to talk and I can't sit around waiting to see if it fills or not. That was it. Just trying to enhance the probability of getting a quick fill. But guys, we've accomplished what I set out to do today. I wanted to spend the bulk of our time talking through this tough decision that sometimes a covered call trader has to make when they have a stock that's not really doing much for them, or even it's starting to misbehave. Do they hang on to that thing and continue pursuing income, or do they just cut ties with an unproductive security? So hope you enjoyed that discussion. I really like the back end discussion, the management of these trades. I think that's probably the most important part of the trading process. It's always relatively easy to get into something. Knowing when to get out can be difficult, right? So hopefully that was helpful. This is what we do on these Monday discussions. So hopefully you'll put it in your calendar to join me each Monday. But I'm going to let you go. Enjoy the rest of your day. As I do, though, just make sure that you're aware of the full slate of educational resources available to you from Schwab Education, starting with the Trader Talks channel on YouTube. If you haven't subscribed to our channel yet, go do that right now. You can pop down below the video, just click on the subscribe button. It doesn't cost anything. It only takes 1 second to do it. You just click subscribe and you're done. But our Trader Talks channel on YouTube is where you can join these live discussions. You can also find the playlists of previous live discussions, and even some that weren't live, and we just add little pre-recorded videos. So for example, if you want to find this series playlist, you click on playlists. This one, it's kind of toward the bottom. You scroll down toward the bottom, it's about 3 rows up. There it is, covered calls and short puts, and you can find the series playlist right there. Now, another thing that Barb and I would suggest you do is to follow us on social media. The only place to contact me in between the live streams is on social media, either on X or on LinkedIn. So you can follow Barb and me on X. You can find Barb there on X at Barb Armstrong CS, or you can find me on X at Cameron May CS. So here's my handle. And if you reply to one of my posts here, I just try to reply right back to you. I replied to about probably 40 posts, 40 replies just this morning. So yeah, I still have some more to do today. But I also am active and reply back and forth on LinkedIn. So on LinkedIn, you can find me. Let me bring that up here. There we are. LinkedIn.com/in and then /Cameron May CS will take you right to my profile. You can find and follow Barb here as well. I've only been on LinkedIn for a couple of months, but if you reply to one of my posts here, I'll just reply to those comments as well. All right, everybody. Thanks for giving me your time today. Barb, thanks for helping out in chat. That's always appreciated. Barb always does a fantastic job. I will see you all in a future webcast. And as we close things up here, I also want to say a final appreciation for everybody that's already clicked the like button. That helps. It's always received as kind of a pat on the back to your presenter. It's kind of like applause for a job well done. But it also gives us a boost in the YouTube algorithm, helps more people find these videos. So Yeah, if you like one of our videos, click the like button. I can see 125 people watching the live stream right now, and 48 have clicked that like button. Thank you for that. Appreciate it. Everybody, I'll see you next Monday, or I'll see you in one of my other webcasts between now and then. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.